Good morning, and welcome to the first edition of the Balanced Perspective for 2023. I'm your host, Mansoor Naka, investment analyst here at Nate Group Investments, taking over from the legendary David Levinson. As always, we're welcomed by Iain Power, CIO at Truffle Asset Management. Good morning and welcome, Iain.
Morning, Mansoor, and great to have you in the studio.
Thanks, Iain. Of course, the topic today, around the world in 15 minutes. For just some context, it's been a great start to the year for markets after the turmoil that we've had last year. Just recapping some year-to-date performances. Emerging markets up to 9%, developed world equities up around 6%, same with S&P 500. European equities giving us 8%, and locally we've seen the JSE give us roughly 9% for January. So as we kick off our tour of the major regions, Iain, your thoughts, starting in emerging markets. I think largely it's been a China story, China lifting the tide for all markets. We've seen that about turn with China basically banning in zero COVID policy. How durable do you think this rally is, and what are your thoughts about emerging markets at this point?
Yeah, Mansoor, I think that's right. I think, quite a sharp move, I guess, in all risk assets for year to date, and interestingly, some of the long duration risk assets as well. But I think from a catalytic perspective, China for EM and for Europe to some degree was also quite a big driver. So I think the removal of COVID zero policies really catalyzed an expectation of better earnings prospects for EM. And as you know, lots of EMs really derive many benefits from the likes of China, particularly some of the resource countries and some of the Southeast Asian emerging markets as well, benefiting from Chinese uptake in Chinese expenditure. And I think the expectation of that happening is pretty high. I think what's probably interesting just to take a pause and think about is perhaps the shape of the Chinese recovery and growth this year might look a little bit different to what we've seen in the past. As many of you know, fixed asset investment is about 45% of Chinese GDP, and property makes up about 30% of their GDP. And I think that's the one area where we're likely to see a lower impetus in terms of recovery, and perhaps more of the recovery focused on consumption and services. And I think if the West was anything to go by, after they opened up, people's need to travel, to get out to restaurants, to spend, to try and be normal after a long period of isolation, I think we're likely to see that. Whereas on the property side, I still think they're suffering with quite a big overhang, and we're likely to see still further pressure in that sector for the year. Perhaps offset a little bit by infrastructure spend, but I think generally we can expect the Chinese reopening to be positive for emerging markets, and also for Europe, which is very closely linked to the likes of China. And I think the big point to make is, from a valuation point of view, emerging markets and perhaps some of the European markets were a lot cheaper than their US counterparts. And hence I think we've seen quite a nice sharp move there, and I think that will be rewarded with some earnings upgrades and better earnings prospects from those companies in those particular jurisdictions. So I think that bodes well.
Indeed. I mean, we just look at China. I think the lows was in October 22. Since that time, China alone is up some 50%. So quite a change in narrative there. Iain, you mentioned Europe is good for China. Just moving on to Europe, the energy crisis that everyone so hotly anticipated, that seems to have been avoided, thanks to a milder winter. Gas storage seems to have been not an issue. The prospects looking much better for Europe this year?
I think they do, and I think a combination of, as you said, a bit of luck in terms of the weather and the ability of them to get higher LNG gas storage and supplies bodes well for them. But having said that, I still think it will be tough, and whether Europe goes into recession or not remains to be seen. But I think China opening up will certainly put some wind in their sails as well, and I think that should be positive for Europe. I think the big key for Europe was really that European equities were pricing in quite a dismal outlook in terms of growth, where you had multiples, well below long-term median and earnings bases which were fairly low. So I think the bounce that we've seen in some of the European names has certainly been good. And I think, Europe can at least have a sigh of relief this year to the extent that two of the big negatives, China and high energy prices, have abated. And I think that'll be good, and I think we'll probably see that come through in better corporate earnings into the back end of the year, particularly those businesses which are geared towards the service sector, tourism, etc., where they're likely to be the beneficiary of these 100 million Chinese who will be looking to escape lockdown and travel and normalize their lives.
Of course, the other big issue in Europe is, of course, the Ukrainian crisis, and that is still unresolved. But do you think the longer as that drag on, it becomes less of an issue? Of course, the humanitarian issue, of course, very disappointing. But when it comes to markets, do you think that becomes less of an issue for markets? It's already priced in, sort of, just dragging on. Your thoughts on that?
Yeah, I think, man, so if we look, for example, the big delta was the energy shock. And energy prices in Europe are now down to levels below what we saw, prior to the invasion. Obviously, there's still a logistics and impact in terms of other commodities, and of course the tragic loss of human lives. But I think the conflict is nowhere near over, and if history is to repeat itself, most of these conflicts end in some sort of negotiation, in the end. But I do think that we haven't seen the end of Putin, and certainly the West seems to be upping the ante in terms of some of the hardware and the military equipment that they're prepared to send to the Ukraine. So I think, there's obviously still those left tail risks and what potentially that outcome could look like. But, certainly I think a lot of that big negative impact which came through in the shock through high energy prices, lots of that has now dissipated. So I think that's a positive.
Thanks for that, Iain. Moving on our whistlestop tour, of course, coming to the US, the big one impacting, of course, global markets. We just saw Friday, monster jobs report come out, new jobs added for January, over 500,000 new jobs over expectations of around 180. And along with that report, we seemingly see wage growth moderating, markets seemingly pricing a Goldilocks scenario here. Just your thoughts around that, Iain?
Yeah, I think, the US markets, particularly some of those long duration assets, tech, cryptos, the sort of the non-profit type companies having quite big rallies in the January year to date, and really on the prospects of some sort of Fed pivot or a Fed pause. I think that sort of remains to be seen. I think, the economy, the data that we're seeing right now still appears to be fairly resilient and strong. But I think we must remember that monetary policy is a lagging indicator, and it takes some time for those effects of the higher interest rates and the cost of capital to be felt in the real economy. So I have no doubt that as we look into the back end of this year, we're going to start to see quite a sharp slowdown. And we've already started to see, quite a few companies starting to announce layoffs or prospective layoffs, and I think that'll probably just accelerate. And we think that, the biggest slowdown in the US is likely to come through in the goods sector. If you just look at a sort of a trend of US consumption over time, and you look at the impact of COVID, the US certainly has been over consuming. And we think that is likely to normalize, and it's going to manifest in goods companies, reporting earnings which are going to be quite challenging. And I think that should flow through into, lots of the other sectors being tech. With valuations, I guess, not being particularly cheap, given the moves that we've seen in January year to date. I think there's still a fair amount of risk in that US market, but largely through earnings and the potential that earnings outcomes disappoint relative to what is priced in terms of forecasts for S&P earnings growth this year. Interestingly, Mansur, if you sort of strip out energy from the S&P, you can already see a meaningful disappointment from, let's say, the ex-energy component, where there's been significant downgrades starting to come through. But obviously, we've seen energy come through very, very strongly, Exxon doubling their earnings, lots of these businesses earning record profits. So I think, the devil is also in the detail. But generally, we think that the likelihood of S&P disappointing in terms of earnings this year is pretty high. And I think that's likely to remain a headwind for the market, notwithstanding a potential Fed pause.
So despite the good performance that we've seen year to date, really not the time to be complacent and just be aware of those risks. Iain, to bring it back home, coming back to South Africa, it's really, we are aware of all the issues hitting us locally. Within the balance fund, you're looking for more sort of global exposure. What are some of those exposures that you're able to get, within our own market?
Yeah. No, I think, Mansur, that's right. I think obviously we sort of SA consumers struggling under the cosh of load shedding and all the associated costs. Having said that, the valuations of some of these SA assets are really, really cheap, particularly from a banking perspective. But what we've tried to do in the portfolio is we've sort of looked at where the valuations are similarly cheap to some of the SA assets from a global perspective, where we've got a higher confidence on the earnings delta. We sort of took reasonably biggish positions there. So, and that would be pretty much focused around some of the miners, Richemont, for example, those luxury companies, both through Richemont and through Kering offshore, both of which have really done pretty well. Bidcorp would be another name where we think should benefit from the backdrop that we've described. And you're not really paying a lot extra for these companies. A lot of these businesses are decent quality companies and should benefit from the macro environment that we've described. Having said that, our barbell in terms of the local exposure comes pretty much through financials. We think some of the big banks, Absa, Nedbank, Standard Bank, look particularly cheap. You're not paying a lot in terms of for those prospective earnings, and you've got dividend yields in some cases which are close to double digits. So, when we're looking for real returns of sort of 6% per annum, the shape of the return from a domestic perspective, at least half of that, you can already bank in the form of a dividend. And we think many of those banks should grow their earnings this year, because what we've seen is with the load shedding, lots of companies, industrial companies, are looking to self-provide, and corporate loan growth in SA starting to accelerate. And those loans that companies are making or taking out to pay for their solar solutions are in fact revenue generating opportunities for a lot of our banks. So I think that's how we're sort of choosing to play that. And then we've got some selective, other domestic names, also, which we think are sort of, pricing in a lot of downside. But generally, the portfolio is split between some global earnings, global earners, which are set to benefit from the China opening up, and from global services. And then on the domestic side, the barbell of financials. And I guess one could tag on a healthy exposure to our local bonds, where we think, you're getting the benefit of, real returns around about 6% which I think is fairly compelling in this environment.
Iain, we've managed to go around the world just about in 15 minutes. I thank you so much for your thoughts and the insights. To our viewers, we have just about run out of time. Thank you so much for joining us. Hopefully you'll join us for the next edition of the Balanced Perspective. But for now, goodbye.
Thanks, Mansur, and thanks to everyone joining us on the call this morning.